Hello, welcome to another episode of Capital Employed FM. For this episode, we welcome back to the podcast David J. Flood, private investor and writer of the Elementary Value blog. If you have listened to episode 7, you'll know that David likes to invest in nets, nano-caps and special situations. In this episode, David gives a quick overview of the latest developments with Mycelx Technologies, the company he talked about in episode 7. He then delves into his latest investment in a nano-cap stock listed on London's AIM Stock Exchange. Before we jump into this episode, do make sure to add your email to the Capital Employed email list. We will be publishing some exclusive interviews that will only be available to those on the list. To receive these bonus episodes, please visit capitalemployed.fm/exclusive and add your email to the list. Okay, let's get into this episode. Please enjoy my conversation with David. Hi David, welcome back to the podcast.
Thanks for having me back on the show, John.
Yeah, it's always a pleasure to have you on. The last time you were on in February, you talked through an investment you made in Mycelx Technologies. Has there been any development since then, and are you still holding?
Yes, I'm still holding the stock, so disclaimer there, I'm long Mycelx. Yeah, there's been a few developments since then. They put out the most recent annual report where they showed they'd suffered quite a large loss, which was no surprise really, because the oil and gas industry's kind of been in a bit of a bear market for a while now. So the shares kind of took a drop on the news of that, but they've quickly recovered back up to support of around 60 pence. And then post-period, they sold their Duluth building that they had and have done a sale leaseback on that. So they kind of shored up the balance sheet with a bit more cash. And the old chairman has stepped down and a new guy's come in to replace him. So the results were, they weren't great, but they were to be expected. But I think looking forward, the prospects for the company are actually quite good because they've developed a new product which is kind of like a retrofit version of their technology, where they can kind of add in a polymer-based system to clean water or air for oil and gas companies and other industrial companies. So before it was an entire system that they had to kind of put in, whereas now they can kind of add this retrofit system into an existing system. So there's a paid trial underway with that with a company. And then they're also looking into cleaning PFASs, which is like another really problematic chemical which has found its way into the environment. And they think there's some bright prospects for that going forward in the future. So I'm quite bullish on the company because I think a new bull market is underway in the oil and gas industry. So I think looking forward out for the next year or two, I think they'll start to get more orders coming in and they'll kind of have their day in the sun again. So I'm very bullish on the company.
Okay, that's great. And how about your new stock that you found? It's a new stock you found on the AIM Stock Exchange, another net nano-cap. What is it and what do they do?
Yeah, so this is an interesting little company. It's called Mycelx Technologies PLC, which is ticker symbol HDT.L. Disclaimer again, I'm long the company. So they're an interesting little company. They were founded in 1972 by a gentleman from Germany, and they're a supplier of materials for printed circuit boards, and they are also involved in lighting and control solutions for buildings. So I was looking through companies on a screener, and I don't really screen for fundamental metrics. I just kind of look at the smallest companies that I can find and just work through them one by one. And I started to look at the balance sheet of the company and noticed that they've got quite a sizable amount of cash and accounts receivable and inventory relative to their market cap. So at the minute, the market cap's £1.8 million. They've got a tangible book value of £3.62 million. They're loss-making at the minute, but they kind of swing from profit to loss like a lot of small companies do. But they're selling at a fraction of the revenue, which is 9.84 million. So they're cheap, if you look at them on a revenue basis. But on a price to net current asset value basis, they're only selling at 60% of the net current asset value. So they're incredibly cheap. It's in net territory. The company also pays a dividend of 1.2%. So I think anytime you find a company like that that's selling at such a depressed level, it's an interesting bet to make, because generally with most nets, unless they're a melting ice cube, you will see a fairly quick correction in the price. But I think at the minute there's a lot of there's a few issues with the company that I think have affected the market's view of it. So I think it's the fact that it's a very small company and it's underfollowed by analysts. No one's really paying much attention to it. The revenues and the net incomes are lumpy with these companies. These very small companies that can have a few bad years and then a very good year. It's very illiquid as well. That's another thing that probably puts a lot of people off. And then I think Brexit concerns and the pandemic have also kind of played into the issues with the company as well. But I think, it's selling at 18 times trailing 12-month revenues, selling at just 0.5 times tangible book, and selling at 0.6 times net current asset value. And you look at the current assets and you've got, 1.1 million in cash, 1.3 million in receivables, 2.34 million in inventory. For me, it's just a screaming buy at this price.
1.8 million, it must be one of the smallest listed companies.
Yeah.
I don't know about this company too much, but I just had a brief look through the annual report and I noticed they're doing a joint venture in Austria.
Yeah.
And they're also doing a joint venture in the Netherlands, I believe. It's Holders Technology Data Analytics. I think it's just commenced trading this year. Do you know much about that? Could that be a bit of a catalyst to help grow the company?
I think so, because traditionally they'd operated supplying materials for printed circuit boards, and then they moved into the lighting solutions business as well. Now, obviously, this business will have taken a hit because of COVID. And then also, I think there was a lot of uncertainty with supply chains over Brexit, but those issues have now been resolved because of the agreement that the UK's struck with the EU. But I think going forward, this joint venture actually with the data analytics could be very interesting, because we're kind of entering the era now where we're beginning to develop smart buildings and the Internet of Things is going to begin to proliferate. So they're basically they're teaming up with another company so they can use all the data that they can gather from their existing systems, where they will implement like wireless lighting systems where they can derive information about a building in terms of the amount of lighting that's used, occupancy rates, energy usage, and then they'll be able to use that information to help companies make cost savings in the future. So I think this is only going to grow in terms of how many businesses use this because of the kind of push towards sustainability. This is going to be quite a major thing going forward. So this could be quite an interesting catalyst for the company to start growing revenues and earnings going forward in the next few years. But I also think there will be a correction in the price, simply for one reason, because the company is trading below net current asset value. Secondly, because I think now that the pandemic's receding, I think revenues will start to grow again and the company could swing to a profit, because it was profitable in the last couple of years before the most recent loss. So I think there's a lot of opportunity there for the company. The stock is very, very illiquid. So the founder and the executive chairman owns about 45% of the shares, and the public float is really quite limited, actually. There's not much stock available because obviously he owns a large percent of the company, and then some other directors own a few shares as well. So in terms of trying to buy the stock, it's quite difficult to build a position. It requires a lot of patience. And what I found with these very small companies where the shares are extremely illiquid is once there's some kind of demand for the shares, when some positive news emerges, the share price can really start to take off then. I mean, you kind of saw that with Micelex. It didn't take long for the stock to move up once the market realised that it was underpriced. And I think the same thing can happen here with this company.
I've noticed the CEO, Rudolf Weinrich, I hope that's how you pronounce the name, that he's 68 years old.
Yeah.
I know 68 years old is not that old. It's not as old as it used to be, perhaps. But yeah, what are your thoughts regarding if owners are that age and perhaps over the next 5 years they may look to retire?
Yeah, it's always an interesting situation when you have things like that going on, because that can be some kind of inflection point where there's change. He may decide that he's kind of ready for retirement and decides to sell the companies to someone else, in which case it could be bought out at a premium. Now, obviously, you never know what kind of price you're going to get if a buyout takes place. But I think with the fact that there's other holders of shares, including certain institutional holders, I think it's unlikely that the company would be kind of taken under, so to speak, taken out at a too low a price. I just can't see how anyone would kind of bid for the company and buy it out. It would be at a premium to the current price just because it's so cheap. So I think that's an interesting possibility going forward. I mean, there's always a risk with these very small companies on the AIM market that they just decide to go private for whatever reason. But the company has been listed for quite a number of years now, so I think the risk of that happening is relatively low. But I'm a firm believer that value is its own catalyst with these stocks. So I expect that there will be a repricing of the stock simply when the market kind of realizes that it's so massively undervalued relative to all the other companies, because there's very, very few nets that are around on the listed markets. So when the market kind of finds one, then generally the pricing is corrected in short order. I'd also mention from a technical analysis point of view, the chart looks extremely interesting with the company. It's been building a base for the last 5 years, and there's a formation which is quite a well-known formation that technical analysts will know, which is called an ascending triangle. And essentially, when this formation completes and you get a breakout, the stock will then begin to move up. So I've been watching that very closely, and I noticed that when I initially started looking at the company. I think it's always good to consult the price chart. So I think a lot of holders of the stock over the last few years have probably given up on the company because it's been languishing down here in the accumulation zone. But for me, that's the perfect time to buy the company before it breaks out on the next rally.
I can see there at about 45 pence, there seems to be a bit of a resistance there over the past few years.
There was a breakout of sorts, but it turned out to be a false breakout, and it's kind of dropped back down. But again, the longer a stock builds a base, generally, the higher the rally that will commence once it breaks out from that base. So I like to find these kind of situations because the upside potential is quite great with them. I mean, if you look back in 2011, the company was selling at 125, 130 pence per share. So I think there's significant upside potential with the company.
Yeah, thanks for sharing that, company. It looks like an interesting situation. Are you finding many more nets or some good deep value stocks around at the moment, or is it becoming a bit more of a struggle?
It's becoming quite difficult to find them on listed markets. There's very little to speak of now on in the US listed markets and even on the UK markets as well. The only places that I'm really tending to find them now would be places like the over-the-counter markets in the US and perhaps places like Eastern Europe.
Do you ever look at Canada at all?
I've looked here and there at Canada in the past, but it's an area that I would like to focus more of my attention on going forward because I think there's some very interesting opportunities up there.
So where can our listeners go to find out more about you?
Well, you can connect with me on Twitter at Elementary Value. You can also get hold of me via my website, which is elementaryvalue.com.
Thanks once again, David, for coming on to the show. You're becoming one of the listeners' favourites, so it's always good to have you come back on.
Yes, fantastic. I'm always happy to join you and have a chat.
Okay, David, thanks for coming on. Take care.
Thanks for having me. Cheers. Bye now.